to an outsider. Within an S Corp, it's a little bit more restricted because there can only be 100 shareholders, and they all have to be U.S. citizens. No other corporation can own it. And there's just a little bit more strings attached to the sale or transfer of an S Corp. And then with an LLC, whoever owns the majority of the business can transfer the business assets as they see without any kind of consent from the management partner or from the limited partner. Sale or transfer at death with a sole proprietorship, typically it's going to dissolve. With a partnership, again, it's going to dissolve unless there was some type of an agreement set. With a C Corp, the stock can be sold. It can be retained unless there was some type of buy-sell agreement in place. With an S Corp and an LLC, they're pretty much the same in that the estate can become an eligible shareholder. If they choose not to, depending on what happens, then it would go back to the same rules that apply during the lifetime of the business. So that takes us to the fact that most business partnerships or entities are always started with the best intentions in mind. They just don't always end that way. So that, the two things to look at in regards to a business continuation plan are what are the heirs of the deceased owner going to want, and then what's the surviving owners going to want. Well, the heirs of the deceased owner are going to want top dollar for their interest, whereas the surviving owners are going to want to have minimum cost for the interest. The heirs are going to want a prompt settlement of the estate, and the surviving owners are going to want a prompt transition of the business so that there's no business interruption. The heirs are also going to want there to be a value set for estate tax purposes, whereas the business is going to want a continuing line of credit. They're not going to want to have to tie up their cash in training and searching for new employees and paying off heirs. They don't want to create an immediate cash flow concern, and then they don't want to have to liquidate any asset unexpectedly. The heirs of the deceased owner are going to want relief of worries from creditors and from business worries. And then the surviving owners are going to want continuation of business. They're not going to want to lose clients. They're not going to want to create lack of confidence. They're not going to want to break trust that they have with their existing creditors, investors, and clients. So, go ahead.
Quick question. When you're distinguishing between existing owners or the owners of the business, are you talking about partners or shareholders and so forth? Are the heirs don't count as an owner? Do the heirs count as an owner? Are they not an owner as well?
Well, if there's no agreement set up and an owner were to pass, yes, you would have problems associated with the heir is going to become an immediate owner of that business.
But you're saying their interests are different than
absolutely, because they're going to want top dollar for it. If they're going to sell it back to the business so that there's no business interruption, they're going to want to be compensated heavily for that. Whereas the existing owners aren't going to want to have to come up with this immediate lump sum to pay off the heirs, right? So they're going to want to sell it to as minimum as low a cost as they can. So it's just if there's no that segues great to the next topic that I'll go to, and that there needs to be a written agreement in place, because if there's not, the problems that you're going to have is that you're going to have conflicts between the heirs and between the owners. And if there is that discontent on both sides, it's going to lead to litigation issues. A will is not necessarily the answer, because the surviving heirs can attack a will and it can hold things up. Obviously the will can help, but it's not an unbreakable document, basically. It's going to create delays in settling estate issues on the heir side, and it's going to create delays in continuing business growth on the owner side. So I hope that's kind of answers the question.
I would just presume that the heirs would become owners as well.
Well, what if they don't want it?
Yeah, if they don't want it.
What if they have no interest at all in that business whatsoever? They just want out.
Is that usually what happens?
Well, I think it also depends on, say you leave 3 kids.
Sure.
So now you have 3 additional owners for
Right.
one part, for one place, and does one want it and the other ones don't? So it's how you divide, how do you look at it in terms of who is going to take over that responsibility when you have multiple heirs in that situation? Does that help?
Yeah, and then a specialty type business too. Like Jesse, for example, in the HVAC business, his wife might have absolutely no knowledge whatsoever of that business. So yeah, she might want to jump in and continue it, but she can't.
Yeah.
So it's a situational basis to if it's going to cause a problem or concern. So with a written agreement in place, you're going to ensure it's going to benefit both the heirs and it's going to benefit the surviving business owners. It's going to create an orderly transfer of the business if something were to happen. You're going to be able to establish a mutual sales price, and a sales price, that gets a little bit sticky because which valuation method do you use? And there is probably an infinite number of valuation methods. One of the more common, I guess some of the more common valuation methods, one is book value, and book value is going to look at basically your most current assets versus your liabilities on the most recent balance sheet of the business. Another method, which is very good for a well-established business with a strong financial history, is capitalization of earnings. That will basically look at the previous year's profits and basically the value of the business on that. There's also an appraisal method, which at the time of a buyout, a professional business appraiser will come in and establish the value of the business at that point. Another benefit of a written agreement is the terms of the sale when it were to happen, if something were to happen. And that is, does the business have to provide a lump sum payment up front? Is there going to be some sort of payment plan incorporated? Is it going to have to be paid off in 3 years, in 5 years? What's an acceptable interest rate on that? Another benefit is it's going to establish a rate that is binding for the IRS for a federal and state tax purpose, and then it's going to create stability for your customers, your clients, your creditors, your investors. So that takes us to what are the different types of a business continuation plan. The first one that I wanted to talk about was buy-sell agreement. And a buy-sell agreement is not a life policy. It's not a disability policy. A life policy or a disability policy can be part of a buy-sell agreement. A buy-sell agreement is protection for a business from a co-owner wanting to leave, sell his or her shares, goes through a divorce, passes away. It's basically like a premarital agreement for a business. There's two different types of buy-sell agreements. One is called a cross-purchase plan, and one is called an entity plan. They're basically the same concept. The difference is a cross-purchase plan, like say Blake and I were in business together, I would take out a policy on Blake, I would be the owner, I'd be the beneficiary, and Blake would take out a policy on me, he would be the owner, he'd be the beneficiary, and that way if something happened to me, he would have the cash to buy out my heirs. Right. Not saying that Blake would do anything. So an entity purchase plan, how it differs from a cross-purchase plan is the entity itself buys the policies on the owners. So there's no one owner is the beneficiary. The business is the actual beneficiary of the plan. The benefits to the business are peace of mind. It's going to create money to provide a fair market exchange if something were to happen. It's going to offer tax advantages. You're going to guarantee a buyer to the heirs of their assets, so the buyers don't have to worry about finding, or the heirs don't have to worry about finding a buyer of the assets. And then it's going to provide the surviving heirs cash to settle any kind of estate issues or tax issues that happen at the passing. The benefits to the remaining owners are it's going to guarantee that the assets aren't going to be transferred to somebody that's not suitable. So it's going to protect the business and keep the business going. It's also going to ensure the continuity for the employees, for the creditors, for the investors. The next type of continuation plan is what's called an executive bonus plan. An executive bonus plan, it can be called an executive bonus plan, it can be called a double bonus plan. An executive bonus plan is a means for a company to basically bonus income to the executive or employee to be able to fund a life insurance policy. A double bonus plan would be, like, say your life policy was $100 a month. In an executive bonus plan, they would bonus you an extra $100 a month on your earnings that you get. Well, after you pay taxes, you're not taking home $100 a month, you'd be taking home $75 a month or whatever it would be. So in a double bonus plan, you figure out what the tax would be needed so that after taxes, you're going to take home the total amount to be able to pay the full premium. The benefits to the employer here is it can be selected. There's absolutely no discrimination rules in place. The premium cost that you bonus to the employee is tax deductible because it's seen as business, or it's seen as employee income. The creation is simple, requires absolutely no administration, so there's no administration fees. And then the plans can vary from person to person, so you don't have to, it goes back to this discrimination issues. You don't have to have the same executive bonus plan for one as you do the other. The benefits to the employee here are, because the business is bonusing the money to the employer or the executive, the employer or the executive is the owner of the policy, so they have control of the policy. So if they transfer to a new firm or a new company, the policy doesn't go away. The policy goes with them, and they have the control of, do I want to continue this, or do I, maybe I do want to surrender it. Because they're the owners, they can choose the beneficiaries. So the business itself is not the beneficiaries. Their heirs or whoever they choose are the beneficiaries. The cash value, if any, that builds up in the policy, they have control of. So they can, if there's an emergency situation, they have access to that value. It can supplement retirement. It can, supplement any type of other investments. And then, as with all life insurance, the death proceed, the death benefit would come out income tax free to the beneficiaries. And then the last type of continuation plan would be key employee insurance. And this one it's very similar to an executive bonus plan, but with an executive bonus plan, the executive or the employee is the owner of the policy, and they choose the beneficiaries. With a key employee plan, the business is the owner of the policy, and then the business is the beneficiary. And this is a safeguard against, if you have a key employee that, passes away or becomes permanently disabled or something, it's the business's protection of finding, training, recruiting, all the time spent on getting another employee to come back in that's going to get up and running is, as efficient as what your key employee was. And basically it's like a bridge of keeping business running. The benefits, it's going to guard against a weakening company's credit rating. It's going to provide cash to fulfill any promises that were made to the decedent's family, such as a deferred compensation or a salary continuation of some type. You're going to avoid missed business opportunities because of that cash being tied up in training and recruiting. And then you're going to minimize the loss of your confidence in your suppliers and your customers. So that's the three main types of continuation planning. In the back of the handout I gave you, there is a list of commonly asked questions. I'm just going to let you guys read those. I don't want to just hold one up and read it word for word. Most of the stuff that I went over is in these handouts for the most part. If you have questions, obviously you can shoot me an email or give me a call. Other than that, as it relates to any continuation plans, does anybody have any stories or any questions?